The next person who may control U.S. interest rates, mortgages, credit cards, business loans, is no longer a mystery, and the choice is already raising big questions about the future of the economy. President Trump has nominated Kevin Warsh to replace Jerome Powell as chair of the Federal Reserve, and this decision could shape inflation, jobs, and the cost of living for years to come. But here's the part that makes this story especially interesting. Warsh isn't a typical political outsider, yet his views on interest rates appear to have shifted in ways that could redefine how the Fed operates. So who is Kevin Warsh really? And what might change if he takes the top job at the world's most powerful central bank? Let's start with why this nomination is such a big deal. Not politically, but economically. The Federal Reserve Chair influences decisions that affect nearly every American household. The Fed's role is to promote price stability and support employment, and its main tool is interest rates. When rates move, borrowing costs change, spending patterns shift, and markets respond. That's why the person leading the Fed is often seen as one of the most important economic decision makers in the country. And now, according to public statements, President Trump has selected Kevin Warsh as his choice to lead that institution once Jerome Powell's term concludes. But what makes this nomination different from a routine leadership change? Historically, Fed chairs are expected to operate independently from political pressure. That independence is often described as central to market confidence and long-term stability. However, over the past year, public disagreements between the White House and the Federal Reserve have become more visible. Trump has repeatedly expressed frustration over interest rate policy, particularly regarding the pace of rate cuts. This nomination arrives against that backdrop, a period where the relationship between elected leadership and the central bank has been widely discussed by economists and analysts. So the natural question becomes, is Warsh being chosen for continuity or for change? Unlike some potential nominees in the past, Warsh is not an unfamiliar name inside central banking circles. He previously served as a governor on the Federal Reserve Board, beginning in 2006, and notably, he was one of the youngest individuals ever appointed to that position. During that time, he was involved in policymaking during a period of major economic stress, including the global financial crisis. That experience gives him credibility in financial and policy communities. But it also puts a spotlight on his past views and how they compare to his more recent statements. Because this is where the story takes an interesting turn. Earlier in his career, Warsh was often described as someone strongly focused on inflation risks. Public records from past meetings show he expressed concern about price pressures, even during periods when economic growth was slowing. Fast forward to more recent months, and several of his public remarks suggest support for lower interest rates than he favored in the past. That shift has led analysts to debate, is this an evolution based on today's economic conditions, or does it signal a broader change in how he might approach monetary policy if confirmed? There's no simple answer yet, and that uncertainty is exactly why markets and lawmakers are likely to examine his record very closely during the confirmation process. Central bank leadership affects expectations, and expectations influence behavior. From Wall Street investors to small business owners. If markets believe rates may fall faster, financial conditions can ease even before policy officially changes. If they expect caution, the opposite can happen. So a new Fed chair doesn't just bring new votes at meetings. They bring new signals, new communication styles, and potentially a new philosophy about risk, especially the balance between controlling inflation and supporting economic growth. And that balance is never simple. Another topic likely to surface during confirmation hearings is the broader issue of central bank independence. Lawmakers from both parties have historically asked nominees how they would maintain policy decisions based on economic data rather than political preferences. Warsh is expected to face similar questions, especially given the public discussion surrounding rate policy in recent months. How he answers could shape perceptions not only about his leadership, but about the Fed's direction as an institution. Policy views are only one part of what makes a Fed chair effective. Communication style, internal leadership, and institutional management all matter. Warsh has previously spoken about structural and operational aspects of the central bank, including how it organizes its workforce and tools. Some of those ideas suggest he may support reforms beyond just interest rate decisions. If that happens, this wouldn't simply be a change in policy tone. It could represent a shift in how the Fed functions internally. And that raises another key question. Is this nomination about short-term rates or long-term institutional direction? Even though the nomination has been announced, nothing changes immediately. The Federal Reserve Chair must be confirmed by the Senate, and that process is designed to be detailed and public. This is where Warsh's past statements, speeches, and policy positions are likely to be examined line by line. Senators typically focus on three core areas: commitment to price stability, approach to employment and growth, dedication to institutional independence. In hearings like these, tone matters just as much as policy. Markets often react not only to what a nominee says, but how they say it. A single phrase about inflation risks or financial stability can move expectations, so the confirmation stage becomes more than a political step. It becomes an early signal about the future direction of monetary policy. If confirmed, Warsh would step into the role at a time when the economic environment remains complex. Inflation trends, consumer demand, labor market conditions, and global developments all feed into rate decisions. A Fed chair must weigh risks on both sides. Cut rates too quickly, and inflation pressures could reappear. Keep rates elevated for too long, and growth could slow more than intended. This is why analysts often describe monetary policy as a balancing act. It's not about dramatic moves, it's about calibration. And this is where Warsh's evolving public stance becomes important. Observers will watch closely to see whether his decisions lean more toward preventing inflation surprises or supporting growth momentum. The chair doesn't act alone. The Federal Open Market Committee includes multiple policymakers, and consensus building is a key part of the job. Former Fed officials often note that the chair's influence comes from framing discussions, setting meeting agendas, guiding communication after decisions. So leadership style can affect outcomes just as much as economic forecasts. Warsh's earlier experience on the board suggests familiarity with this process, but leading the institution is different from being one voice among many. The transition from governor to chair involves managing viewpoints, shaping narratives, and maintaining confidence during uncertain periods. Modern central banking relies heavily on forward guidance, explaining not just today's decision, but how future decisions might unfold. Clear communication can reduce volatility and help households and businesses plan ahead. Uncertainty, on the other hand, can tighten financial conditions, even without a rate change. If Warsh takes the role, his communication style will be closely analyzed. Does he signal flexibility, caution, urgency, stability? Those signals ripple across markets long before any policy vote happens. It might sound like a high-level institutional story, but Fed leadership decisions eventually filter down to everyday life. Mortgage rates, car loans, small business financing, and savings yields are all influenced by broader rate expectations. While many factors contribute, central bank policy remains a foundational piece. That's why changes at the top of the Fed attract attention from economists, investors, and households alike. It's not just about one appointment, it's about the framework guiding future economic decisions. Some analysts believe this nomination could mark a moment of transition in how the central bank approaches its structure and tools. Warsh has, in past remarks, discussed the scope of central bank actions and the boundaries of its mandate. If those views influence policy direction, the conversation may extend beyond rate levels into questions like how large should the Fed's balance sheet be? How should emergency tools be used in future downturns? What is the right balance between market support and long-term stability? These are institutional questions, not just short-term policy ones, and they often shape the economic landscape for years. Whenever leadership transitions are discussed, uncertainty naturally rises. But in economics, uncertainty also reflects adjustment. Markets reassess, institutions adapt, and expectations reset. The key factor is clarity over time. As more information emerges from hearings, speeches, and public communication, expectations tend to stabilize. That process is already beginning. What this nomination ultimately represents is not a sudden shift, but the beginning of a new chapter in U.S. monetary leadership. The outcome will shape how the country approaches inflation risks, growth challenges, and financial stability in the years ahead. But one question remains open. and it's the one lawmakers, markets, and economists will all be listening for. How does Kevin Warsh define the Fed's role in today's economy? In the next part, we look beyond the nomination and into the person himself, his background, career path, and the experiences that shaped his approach to economic policy. Understanding that journey helps explain what kind of leadership style he might bring to the Federal Reserve. Continue watching for the full profile. From policymaker to nominee, the person behind the decision. Before any vote is cast or policy direction is signaled, there's a deeper layer to understand: the professional journey that shaped Kevin Warsh's perspective on economics, markets, and institutions. Central bank leaders don't form their views overnight. Their decisions are influenced by academic training, private sector experience, crisis moments, and years of observing how policy plays out in the real world. Warsh's path includes each of those elements, which helps explain why his nomination is drawing attention across financial, academic, and policy communities. Who is Kevin Warsh? Kevin M. Warsh is an American economist and policy figure best known for his prior service on the Board of Governors of the Federal Reserve System. He was sworn in as a member of the board on February 24, 2006, and served until March 31, 2011. Born in Albany, New York, Warsh pursued an academic path that combined economics, policy, and law, a mix that later defined much of his career. He earned his bachelor's degree with honors from Stanford University in 1992, studying public policy with an emphasis on economics and statistics. He later attended Harvard Law School, where he focused on the intersection of law, economics, and regulatory policy, earning his law degree in 1995. His education also included coursework in market economics and debt capital markets at Harvard Business School and the MIT Sloan School of Management. After completing his education, Warsh entered the financial sector. In 1995, he joined Morgan Stanley and Company in New York, working in mergers and acquisitions. In that role, he advised companies across industries such as manufacturing, materials, services, and technology. His work included helping structure capital markets transactions and facilitating both fixed income and equity financing. This period gave him direct exposure to how companies raise capital, manage risk, and respond to market conditions, perspectives that later informed his views on financial stability and monetary policy. In February 2002, Warsh left Morgan Stanley to join the administration of President George W. Bush. He served as Special Assistant to the President for Economic Policy and as Executive Secretary at the National Economic Council. In this role, he advised senior officials on issues involving capital markets, securities, banking, and insurance. He was also a member of the President's Working Group on Financial Markets, which focuses on financial system stability and coordination across regulatory bodies. President Bush nominated Warsh to the Federal Reserve Board of Governors in 2006. During his tenure, he participated in policy discussions during a period that included the global financial crisis. He served as the board's representative to the Group of 20, G20, and engaged with both emerging and advanced economies in Asia. He also carried out duties as the administrative governor, helping oversee board operations, personnel, and financial performance. During this time, Warsh delivered several speeches addressing economic conditions and monetary policy during extraordinary periods. These public remarks contributed to his reputation as a policy thinker, engaged with questions about financial stability and the role of central banking tools. After leaving the Federal Reserve in 2011, Warsh continued his work in economic policy and academia. He became a distinguished visiting fellow at Stanford University's Hoover Institution and has served as a lecturer at Stanford's Graduate School of Business. He has also advised companies in the private sector, including serving on corporate boards. These roles kept him connected to both academic research and real-world business environments. Warsh married Jane Lauder in 2002. She is a business executive associated with the Estee Lauder Companies. The couple met while attending Stanford University. Why this background matters? Warsh's career bridges three major worlds. 1. Financial markets, private sector experience. 2. Executive branch economic policy, White House role. 3. Central banking, Federal Reserve Service. That combination means his perspective is shaped not just by theory, but by exposure to market dynamics, regulatory frameworks, and crisis-era policymaking. For lawmakers evaluating his nomination, this background provides context for understanding how he might approach leadership, communication, and policy trade-offs. This nomination story isn't just about a title, it's about the direction of monetary leadership, institutional philosophy, and economic strategy in the years ahead. As the confirmation process unfolds, more clarity will emerge about policy priorities, communication style, and long-term institutional goals. Understanding Kevin Warsh's journey helps frame those discussions, not as isolated decisions, but as part of a broader professional arc shaped by markets, policy, and global economic events.